Hello and welcome. In this month's on-demand webinar, OJM Director of Wealth Advisors, Bob Peelman, provides a market outlook for 2019. He discusses U.S. and global economic factors, estimated asset class returns, and reasons for optimism for long-term investors. It's important to note that this video is for informational purposes only, and the information may not be suitable for your personal circumstances. Please contact a professional before attempting to execute any of these strategies. If you find this information helpful, we would encourage you to check out one of our books. We'll discuss how you can get a free ebook download or hard copy of Wealth Management Made Simple or any of our other books.
Hello, I'm Bob Peelman, the Director of Wealth Advisors here at OJM Group. As we look back at the end of 2018, it was a challenging year in the fourth quarter for U.S. stocks and markets broadly. U.S. stocks fell 13.6% for the quarter, actually recording one of the worst quarters in the last 7 years. For the year, U.S. stocks were down a more modest 4.5%. And the negative year broke the S&P 500's 9-year run of positive returns. Foreign stocks also struggled, with developed international and emerging market stocks both ending the year down just under 15%. So as we look at this graph here, the blue bar represents the fourth quarter, and you can see year-to-date returns as well. So across the board, from U.S. large cap, U.S. small cap, developed international, emerging markets, alternative strategies, managed futures, across the board, it was a very difficult fourth quarter and a difficult year in total. Core bonds typically perform well when stocks do poorly, had some losses through November, but had a nice strong rally in December, specifically led by Treasury bonds. So you can see investment grade bonds were up slightly for the quarter, 1.6%. And then the high yield and floating rate sectors struggled a little bit. So it was definitely a flight in the fourth quarter to safety as we go through looking at what was across the board an extremely difficult year for financial markets. It was a very difficult year to make money. This is a pretty neat graph here showing the percentage of categories with negative returns. So going back here to 1990, you can see here in 2018, 84 of the 105 Morningstar categories had a negative return in 2018. That's 80% of the categories. We've not seen anything like that since 2008 when we were experiencing the financial crisis. So definitely a year that across the board was difficult to make money. And that's illustrated here as you look at the Q4 returns for all of the large cap indices, small cap indices in the United States. Developed international stocks, again, sold off quite a bit. Emerging market stocks were down, but not down quite as much as we saw the reversal in the U.S. markets. Real estate, where we really only had positive returns, came in the way of cash, bonds, municipal bonds, and global investment grade bonds as well. So if you look at the final year, we had negative returns across the board in the U.S. Developed international and emerging markets struggled by double digits, down 14%. We'll talk a little bit later on in this presentation about our views on emerging market stocks and specifically developed international stocks as well. And 5-year annualized returns. So if we look at the 5-year returns across most U.S. markets, still some pretty solid returns ranging anywhere from 3.5% with small cap value, upwards of 10.23% in large cap growth companies, developed international stocks, emerging markets stocks down in the low single digits. Real estate has performed well over the last 5 years across the board. So just really illustrating here the difficulty in 2018 to make money across the board in a variety of different asset classes. In our view, volatility is likely to remain elevated over the short term. So it certainly returned in 2018. There's no doubt about that. And this is in contrast with 2017's strong market results, but also very low in volatility. So as we look at the graph here and look at the number of S&P 500 daily price moves, plus or minus 2% per calendar year, you can see in 2017, we had 0, 2016, only 9, 2015, 10, and then 6, 4, and 6 going all the way back to 2012. So we've been in this very low volatility, calm market, steadily rising across the board going back to 2012. That obviously changed quite a bit in 2018. So where do we go from here? We talked a little bit about 2018, where we were, what happened, what the quarter looked like, but what's our view as we look forward to this year? So we certainly think from a macroeconomic standpoint, we have uncertainty, and we think that's going to be elevated with a wide range of outcomes here in the near term. Let's think about some of these questions that we're currently facing. We are in the midst of a trade war. Will that abate as we go throughout the course of this year? How much will China stimulate their economy? So what is China going to do during this trade war that they're currently experiencing? Some of the difficulty they're experiencing with the slowdown of their GDP. What tools will they use to stimulate their economy? Will uncertainty remain elevated across the Eurozone? So we've heard quite a bit about Brexit, quite a bit of uncertainty across Europe as it relates to, from a political standpoint, what that environment's going to look like. I think we'll probably get more answers to that in the first part of 2019, but certainly it's going to be a big part of what the market's considering as we move forward. Here in the U.S., will the Fed keep raising rates? This has been something that was talked about quite a bit in 2018. We heard about it from a political standpoint, that there was a viewpoint that the Fed was raising rates too aggressively, and that there wasn't really the need to, from their mandates of inflation, unemployment, that these things seemed in control. One of the things that led to the sell-off in the fourth quarter was some of the language from the Fed that they had some more room to go as far as raising rates and slowing down the economy. Since that point, really after Christmas Eve, where the market bottomed out, the Fed came out and gave some language on they are going to be much more nimble. They've heard the markets, they're listening, and that they're much closer to normal than they had previously mentioned. Markets got very excited about that, thought that there could be, maybe one more rate hike in February, maybe one more after that, or maybe no more. So that's something to keep an eye on as we think about how to allocate assets. How will the U.S. economy and global financial markets perform in a late cycle environment? So everyone keeps hearing about yield curve and recession. One of the things that's not mentioned is many times there's very good market returns as we get late into this economic cycle. And now many economists are coming out saying we're not quite as close to a slowdown in our economy specifically as we might have thought last year. So there still may be quite a bit of room to go as it relates to our economic growth here in the U.S. And that ties into the next question: is a global and or U.S. recession on the horizon? It's a very difficult thing to predict. Recessions, they're very rarely predicted accurately. And what this does is it causes a lot of anxiety in the markets where folks are trying to predict, is a recession 6 months away, 12 months away, 18 months away? As we look at it today, I don't think a recession is necessarily on the horizon for 2019. It could be on the discussion point of a slowdown in 2020 or now even into 2021. But something certainly as we build a model for clients and we look at asset allocation decisions that we factor in. And then how much of the macroeconomic uncertainty is already discounted in the financial markets? Remember, financial markets are leading indicators. So what is happening today in the markets is a prediction about what will happen 6, 8, 12, 18 months now in the economy. So I do think that the markets has priced in quite a bit during this move back in the fourth quarter about some of these uncertainties and some of these questions that we just mentioned. If a few of these turn to a positive situation, let's say a trade war ends with China and we have a beneficial agreement for both sides and global growth uncertainty sort of washes away, I think you're going to have an environment where the market's going to respond very positively to that. Also, if the Fed keeps interest rates with one hike, maybe two, gives some language that we've now reached a more normal environment, I do think the market's going to respond favorably to that as well. So these are things to watch for as we look into 2019. So the synchronized global expansion was knocked a little bit off course in 2018. So over the next 12 months, uncertainty is high, and the range is wide for possible outcomes. So we look here at these leading economic indicators in the U.S. and globally, and for the first time, you can see some of those back in July. There was a lot of fear globally, ex the U.S., about some of the expansion, and a lot of that came from discussions as it related to China. So something we're monitoring and keeping an eye on quite a bit. Whether global growth stabilizes or reaccelerates is key. So this is a pretty neat chart here on manufacturing indexes producing in Europe and emerging markets as well as the U.S. And you can see here there has been some slowing as it relates in January across the Eurozone. Emerging markets, not quite as much. The U.S. has been fairly flat and stable. But again, just another one of those metrics that we're looking very closely at as we look at growth. The U.S. economy remains solid, and I think that's a very important point to note. I know a lot of times within the media and talking about where we are today in our economy, it's important to look at that the current U.S. economic expansion will become the longest on record if it does make it past, if it continues into this summer, into July of 2019. You can see here. Our last of this length was sort of sandwiched between March of 1991 and February 1961. Going back to the question earlier on a recession and a prediction of a recession, we certainly all understand that we're late in the market cycle, but the timing of the turn is always very much uncertain. And so you can see here the Fed tightening and recession often coincide. So, looking at the shaded areas represent those defined recessions. And you can see there during a period of significant increases in Fed funds rates where the recession then comes into play. The timing of that, though, and what type of returns you're going to get within the different asset classes, whether it be U.S. stocks or international stocks, emerging market stocks, is really a delicate balance as it relates to rebalancing your portfolio and making sure you're positioned to take advantage of these types of opportunities. So what a global economic slowdown with and without a U.S. recession mean for the markets here? You can look. The average peak to trough decline, global recession with the U.S. can be 45%, global recession ex-U.S. 19%. As we look at the slowdown, which is why it is so important to have a global portfolio, a globally diversified portfolio. It's one of the areas we're constantly focusing in on with our clients and talking about those opportunities. So what's our view? What's our outlook? I think it's important to look at what we think within each asset class and those positionings. So as we look at U.S. stocks, we believe they're overvalued and their medium-term return potential is fairly unattractive. We certainly think that there may be some low single-digit type returns, and we certainly have a meaningful exposure to U.S. stocks across all of our portfolios, but remain underweight relative to our strategic or what we would call our neutral allocation. So for clients coming in, where we would have you positioned normally is probably a little lower from a U.S. equity standpoint. Developed international stocks, the valuations for European stocks are attractive, and we think there's potential for some excess return over U.S. stocks in that upper single-digit range over the medium term. And so this has caused us to have a slight overweight position to Europe currently. From an emerging market standpoint, corporate earnings growth is recovering. It's far below the peak reached before the financial crisis, but the key for emerging market stocks is valuation. Valuation for emerging market stocks remain extremely attractive. So that allows us to continue to have and feel confident about that slight overweight that we have to emerging market stocks. As it relates to investment grade bonds, low current yields and the likelihood of rising rates imply low potential returns. So we are heavily underweight investment grade bonds, and we have been now for some time. And we've allocated those dollars to more flexible, unconstrained, absolute return type bond strategies, floating rate bank loans, to help us generate higher returns, but also manage sensitivity to rising interest rates, and then also keep the portfolio volatility low. So you want to have exposure to bonds for a variety of reasons, most importantly, to keep portfolio volatility much lower, but also derive some income. And we're doing that now more in the flexible core and unconstrained strategies than we would in investment grade. Alternative strategies, we continue to use a mix of strategies within alternative investments, from managed futures to absolute return strategies, fund of funds, where we're looking at a variety of flexible strategies. And the goal there being we're really trying to drive down portfolio volatility and provide a much better risk-adjusted return. So we still feel pretty good about those allocations as we move forward. So what is our asset class return estimates over the next 5 years? Our base case, I think, with the vast majority of the S&P 500 or large cap U.S. stocks, we're looking at that 3.34% type annualized return for U.S. equities. The reason we have such a significant weighting abroad to Europe and both emerging markets in Europe is you can see our base case scenario there of a 16%, 11% return. We really think we can get double-digit type returns based on valuations from those. You can see here the investment grade bonds in a rising interest rate environment, albeit we may be on the back end of that, we still think is going to be 3% or less for our base case, which is why we have allocations to some of the high yield floating rate type opportunities out there. So diving in a little bit on that asset class discussion, why the underweight to U.S. equities, why have global allocations? Again, analyst expectations are often too optimistic. So earnings growth estimates for U.S. stocks, again, are exceedingly high. And in our view, this provides an opportunity to look at the picture evaluating U.S. equities and say, we're probably fully valued in most sectors, most asset classes, and there's an opportunity there to underweight those stocks. So what are some of the issues impacting our global allocations, both international and emerging market stocks? The near-term outlook for both of those is clouded, no question. There's a series of upcoming events that provide some uncertainty, whether it be fears of a global economic slowdown, Federal Reserve tightening, these global trade and tariff discussions as it relates to what's going to happen by March 1st with discussions of China. Will there be more tariffs? The Brexit slowdown, the Italian budget dispute, and then obviously the things that are happening in our U.S. political system with the government shutdown we're currently experiencing. So where do we see optimism? Why do we look at a global portfolio and see opportunity? And so for us, despite some of those near-term issues, uncertainty and fears of an economic slowdown have been discounted by the market, in our view. So the reason we've not got the return over the last 12 months, say from an emerging market allocation or an international allocation, is some of that has been priced in. And in our view, probably a little bit too much and maybe not accurately. The potential for fiscal and monetary stimulus, both in China, Europe fiscal stimulus, Latin America, and Asia, all look to be positives for their markets. Valuations for Europe and emerging market stocks are historically cheap as it relates to the U.S. And this is probably, I'll emphasize this point, one of the biggest reasons we think there's opportunity within these markets. The outperformance of U.S. versus international stocks is just not sustainable. And I've got some slides here in a moment. We'll talk about that, especially at these current valuations. Our active fixed income and equity managers are finding some attractive bottom-up investment opportunities in these specific areas, especially after the recent sell-off in 2018. So we look at PE ratios, price to earnings ratios, and talk about how attractive a company is from a valuation standpoint. We can look here at the U.S. Schiller PE ratio, and you can see here there's been this huge divergence, really going back to the recovery of 08-09, and you can even see more so since 2012 of a rapid increase in PE and valuations within the U.S. versus what has not happened within emerging markets in Europe. So again, this is really about where is value, where's the opportunity to make money while investing in equities, and in our view, on a risk-adjusted basis, that right now comes in a broadly diversified global portfolio. Another nice chart here is U.S. and international returns, relative returns. These move in cycles. So if you look above the line here, this is the rolling 5-year return differences between U.S. stocks and international stocks, and the periods where U.S. stocks have outperformed international stocks. Conversely, below is where international stocks have outperformed U.S. stocks. You can see now we're in a pretty sustained period of time of outperformance of U.S. versus international. And again, this just provides another opportunity, another case for some of those inflated U.S. returns and where we think we can get some opportunity. As we look at some of our alternative investments, managed futures are where we've allocated some dollars for clients right now, and they provide valuable risk management benefits when investors need them the absolute most. If you look at the last 6 bear markets, how managed futures have performed versus U.S. stocks, let's look at the great financial crisis, November 07 to February 09. You're talking about U.S. stocks being down cumulative around 50% and managed futures up around 29.3%. Tech bubble, 2000, 2010, down 44, up 27. So when we're really adding in risk mitigating strategies for our clients, this is one area where we've added 2 particular fund strategies to help during some of these periods. So finally, we'll talk about our base case from an economic standpoint, what we think, base and bull and bear. I'll start with our base case. Moderate economic recovery continues with really no major crisis. Normal recession likely here within the next 5 years, probably sooner rather than later within that 5-year time horizon. We're assuming GDP growth rates and interest rates start to normalize toward the end of this time period, and earnings in the period at a long-term normalized trend line. Treasury yields being higher. That really helps us back into our other base case scenarios as it relates to the markets. From a bear case, the economy falls into recession for a variety of reasons. Could be deleveraging and deflation from Europe and China, sort of unexpected asset bubbles or systematic shocks, Fed policy error, too aggressive too quickly, Treasury yields are lower. So this is an area where we're doing our stress testing. We're looking at our models and still feel very comfortable with how we're allocated to fixed income, to managed futures, underweight to U.S. equities, that this actually still would provide some opportunity, even in a bear case economic scenario. Bull case, we continue this very strong U.S. economic growth, above average earnings, continue on this long-term growth trend, helped by stronger non-U.S. growth, re-leveraging of the U.S. consumer. Treasury yields are higher. So there's a case out there. We feel pretty good about our base case right now, but certainly the bull case is probably even more likely than the bear as it relates to our views on the economy and how we're building our portfolios. So I hope this was helpful for you today. If you have any questions, we would love to do a portfolio review with someone here on our OJM investment management team. Thanks for listening.
OJM is a multidisciplinary wealth management firm, and we've worked with over 1,000 clients throughout the country. We work in 3 different divisions for our clients: investment management, consulting, and insurance benefits. We would welcome the opportunity to speak with you about how we might be able to bring value to your wealth planning. As I mentioned at the beginning of the webinar, our principals have authored several books, all of which are available to webinar viewers at no charge. You can get a free hard copy or ebook download for Kindle or iPad by texting OJM Web to 555-888. You can also visit ojmbookstore.com and enter the code OJMWeb at checkout. In addition to a free book, OJM Group also offers webinar viewers a complimentary consultation where we can answer your questions and see if our firm might be a good fit for your situation. Visit ojmgroup.com or call 877-656-4362 to schedule your free consultation. Enjoy the free copies of our books, and we hope to have the opportunity to speak with you. Thanks for watching.